Okay, let's unpack this. Welcome back to the deep dive. Our mission today is all about giving you a kind of tax code superpower. It's about understanding how certain income can, well, just vanish from your federal return and do it completely legally. We're diving into exclusions.
Exactly. And, it's important to say what these aren't. We're not talking about deductions, which just reduce the income you get taxed on,
Right. Or credits.
or credits, which cut the tax bill itself. And exclusion is different. It's money the government basically says you never even earned for tax purposes. It's a pure, untaxed gain.
And we've pulled together a ton of sources to give you the ultimate shortcut to understanding where these exclusions are hiding. We're talking everything from specific investments to, massive personal asset gains.
Like selling your home.
Exactly. And even down to those small but really important fringe benefits from your employer.
What's fascinating here is that these exclusions aren't just random. They're defined with, surgical specificity in the tax code.
And they're almost always tied to promoting some kind of public policy, right?
Always. You see it encouraging funding for local governments, or pushing people toward better healthcare choices, or supporting stable housing. If you understand the policy behind the rule, it helps you remember the limits of the rule.
Let's start on the investment side then. Let's talk about exclusions related to public purpose. This really is the cornerstone of why certain investors just love municipal bonds.
Correct. So the interest you earn from state and local government bonds, people call them munis, that interest is generally excluded from your federal income tax.
But there's a catch.
There's a catch.
Hmm.
It has to be that the bond's proceeds are used for a general public purpose.
And when you say state and local government, that's a pretty big umbrella. Our sources point out this can be bonds from port authorities, toll road commissions.
Utility services, community development agencies.
Yeah.
Yeah, they're all funding essential public works, things we all use.
So it's a huge tax benefit.
Oh, absolutely, especially for high-income earners.
Yeah.
It creates this kind of tax arbitrage where someone in a high tax bracket can take a slightly lower interest rate on a muni bond because the net tax-free return is actually higher for them than a taxable corporate bond would be.
Okay, so we love the tax-free part, but what's the asterisk? When does the IRS step in and say, actually, no, this one's taxable?
That happens when the bond becomes what's called a private activity bond.
Yeah, private activity bond.
Yeah. If too much of the money, specifically more than 5% of the total, or $5 million, whichever is less, is used to finance private activities.
Like a sports stadium for a pro team?
Exactly.
Hmm.
Or an industrial park for just one company. If that happens, the interest on that bond becomes taxable.
And that taxable interest has a special status we should probably clarify, because it brings up some important jargon.
Yeah.
AMT.
Yes. That interest is considered a tax preference item for AMT, which stands for Alternative Minimum Tax.
So what is that, really?
Well, if you're a high earner, the AMT is basically a whole separate parallel tax calculation. It's designed to make sure wealthy individuals pay at least a minimum amount of tax, no matter how many deductions or exclusions they claim.
And this specific type of interest can be one of the things that, pushes you into that AMT calculation.
Precisely. And just to round out this category, there are a couple other public policy exclusions we found, like the housing allowance for members of the clergy.
Right, which recognizes their sort of unique professional status.
And, of course, Social Security benefits. While up to 85% of those benefits might be included in your income, depending on your other earnings, the fact that a portion is potentially excluded is another policy meant to support seniors.
All right, let's pivot to personal assets. This is the big one. The gain on the sale of your main home, Section 121.
This is where you see a truly massive benefit. The maximum inclusion is $250,000 for a single filer.
And for married couples?
A staggering $500,000. $500,000 for married filing jointly. You could make that much profit on a sale and it just, poof, it never even shows up on your tax return.
And that's why people always say this is a key incentive for homeownership. But you have to jump through some pretty strict hoops, all centered on the 2 out of 5 year rule. Can you walk us through the 2 tests?
Sure. The rule basically says that during the 5-year period that ends on the day you sell the house, you have to meet both an ownership test and a use test.
Okay, ownership test sounds simple.
It is. You had to have owned the home for at least 2 years. Then there's the use test. You must have lived in the home as your main home for at least 2 years.
Which works out to, 730 days?
Exactly, a total
Okay.
of 730 days. And it's important to note that use doesn't have to be consecutive.
That's great for people who travel a lot or have to move for work temporarily.
Absolutely. And the IRS even built in more flexibility. For instance, service members, military, intelligence, Peace Corps, they can suspend that 5-year test period for up to 10 years while they're away on qualified duty.
That's a huge break. But it sounds like there are ways the IRS closes loopholes. So if I move out for 3 years, rent my house, and then move back in for 2 years, I still qualify for the exclusion, right?
You do, yes. You qualify, but maybe not for the full exclusion. And this brings us to the most complicated part of Section 121, periods of non-qualified use.
This is for any time after December 31st, 2008, when the property was not your main home. So it was a rental or maybe a vacation home.
Exactly. And it means you have to prorate your gain.
Let's use the Liam example from our source material to make this real.
Okay, so Liam buys a home for $250,000 back in January 2006. He rents it out from January 2009 to December 2011. That's a 3-year period. Then he moves back in and lives there until he sells it in 2020. So his total ownership was 15 years.
And the key thing here is that the 3 years he rented it out after 2008 count as non-qualified use.
That's the part that matters. So when Liam sells the house for a big gain, let's say his net realized gain is $300,000, we have to split that gain into different categories.
Right. And without getting lost in the exact day accounts, about 46% of his ownership period after 2008 was that non-qualified rental use.
Which means 46% of that total $300,000 gain, so $138,000, is permanently allocated to non-qualified use. It's taxable.
And the other part, the remaining $162,000, is eligible for the Section 121 exclusion. It's under his $250,000 limit, so he's good there.
He's good there.
But wait, because he rented it, he also claimed depreciation against his income during those years. Let's say he claimed $50,000 in depreciation. What happens to that when he sells?
This is the real complexity. People call it the clawback. Any gain that's equal to that $50,000 of prior depreciation has to be taxed separately.
At a special rate.
Yes, at 25%. This is called unrecaptured Section 1250 gain.
So why is it 25%?
Well, the thinking is strategic. When Liam claimed that $50,000 of depreciation, he was writing it off against his regular income, which could have been taxed as high as, say, 37%.
Okay.
So the IRS requires him to recapture that deduction when he sells, but they tax it at a preferential rate of 25%. They make sure they get their cut back.
So to sum up Liam's situation, his $300,000 profit is now split into 3 buckets.
Right. You've got $162,000 that's completely tax-free under Section 121.
Then the $50,000 depreciation recapture, taxed at 25%.
And finally, the remaining non-qualified gain of $88,000 is taxed as a long-term capital gain. It's a powerful lesson in how the whole history of an asset matters.
Let's switch gears to debt, specifically when debt gets discharged. I think it might surprise some people to know that if a creditor cancels a debt you owe, the IRS usually sees that as income.
They treat it just like someone handed you a pile of cash, yeah. It's taxable. But there are major exceptions, and they're usually designed to help people who are in financial trouble.
The big one, again, relates to housing. It's the exclusion for discharge of qualified principal residence indebtedness.
This one is very specific. It only applies to debt that was used to acquire, construct, or substantially improve your main home.
This was a huge policy response after the 2008 crisis, and it keeps getting extended. What's the limit on it?
For discharges that happened after 2006 and before the current deadline of January 1st, 2026, you can exclude up to $750,000 of that forgiven debt.
Wow, $750,000.
It's an enormous relief measure. And it's $375,000 if you're married filing separately.
That 2026 deadline is definitely looming. And speaking of deadlines, student loans have some time-sensitive exclusions, too.
They do. Traditionally, debt discharged because you perform certain services or due to death or permanent disability, that's excluded. But the biggest recent exclusions came from the Tax Cuts and Jobs Act and the American Rescue Plan.
And what did they do?
Those acts basically excluded almost all student loan discharges that happened before January 1st, 2026.
So if you had a big federal student loan forgiven recently, you need to know that while it's excluded now, that policy is set to expire. It's a very dynamic part of the code.
And we should probably just briefly mention a few others. Debt discharge in bankruptcy is generally excluded. And there's a special exclusion for farmers for debt related to qualified farm indebtedness.
Okay, let's turn to the employee side now. Employer-provided benefits, or fringe benefits, these are usually compensation, so they should be taxed, but there are specific exclusions.
Right, and this is where policy meets your paycheck. The most valuable exclusion by far is health and wellness. The cost of health plan coverage provided by your employer is generally excluded from your income. It's one of the most powerful tax breaks out there.
And that also covers those tax-advantaged accounts the employer helps fund, like FSAs, HRAs, and HSAs.
It does. Employer contributions to health flexible spending arrangements, FSAs, and health reimbursement arrangements, HRAs, are generally excluded. But the real star of the show is the health savings account, or HSA.
The HSA is the big policy driver.
It really is. The contributions are excluded from income, the money inside grows tax-free, and if you use it for qualified medical expenses, the distributions are also tax-free. It's a triple tax advantage.
But there's a warning, right?
There is. If you take a distribution from an HSA for something that is not a qualified medical expense, that amount is included in your income. And it's subject to an additional 20% penalty tax if you're under 65. That penalty is there to make sure the account is used for its intended purpose.
Okay, shifting to smaller perks. De minimis benefits. This sounds like the rule for office freebies.
It is. If the value is tiny, coffee lugs, a company t-shirt, the holiday Hammer-beer, it's excluded. The goal is just administrative convenience. The IRS doesn't want to track $5 worth of coffee.
But the crucial thing here that trips people up is cash versus stuff.
Right. If the employer gives you cash, a gift certificate, or any kind of cash equivalent, the exclusion is gone. That money has to be included as wages.
Yeah.
The rule is strictly for tangible, nominal property.
Let's talk about the exclusions for career growth and family support.
Sure. For dependent care assistance, the most an employer can give you tax-free is $5,000. And for educational assistance, it's up to $5,250 of qualified assistance. That's for tuition, fees, books, as long as the education helps you improve your job skills.
There's also a pretty generous one for adoption assistance. For 2025, it's up to $17,280 per child.
That's a great example of the government using the tax code to actively support family formation.
Right. And what about commuter benefits?
An employee can exclude up to $315 a month for transit passes and another $315 a month for qualified parking. It's also worth noting that moving expense reimbursements, except for the military, are currently taxable through 2025. That's a temporary change.
Okay, finally, let's wrap this section with Employee Achievement Awards. What's the most they can give you tax-free for, say, length of service?
The exclusion only applies to tangible personal property, so not cash. And the maximum combined exclusion for all awards in 1 year is $1,600.
And they have rules to prevent abuse, right? Like you can't get an award for less than 5 years of service.
Exactly. And safety awards can't go to more than 10% of employees, and they specifically exclude managers and administrators. It has to be targeted. If we use the example of Ben, who got $1,750 worth of awards, he has to include the difference, $150 in income. That dollar limit is absolute.
So what does this all mean for you, the listener? We've covered these major policy areas where the tax code gives you a very specific, very powerful break.
I think the core lesson is that exclusions are highly targeted. They're meant to do something. They support public infrastructure with tax-free bonds. They encourage home ownership with that massive $250K, $500K exclusion.
And they define what non-taxable support from an employer looks like through things like HSAs and educational assistance.
But the key is that these benefits always come with strings attached. There are strict ownership periods, like the 2 out of 5 year rule, and hard dollar limits, like that $750,000 debt discharge cap or the $5,250 educational limit.
And we learned that the history of an asset really matters. Even when a gain seems like it should be excluded, like with a home sale, something you did in the past, like claiming depreciation, can pull a portion of that profit back into a taxable category.
That 25% unrecaptured Section 1250 gain is a perfect example.
Which brings us to our final thought for you to explore on your own. Consider how these specific income exclusions, especially the ones with hard deadlines, like the student loan or principal residence debt discharge expiring in early 2026, how they represent these dynamic policy decisions, not static tax law.
How do those looming deadlines influence financial planning and behavior today?
Exactly. How do they force people to act or restructure their finances before that window of opportunity, that exclusion, closes for good?
A powerful perspective to think about as you look at your own financial landscape.
A huge thank you for diving deep with us today. We'll catch you on the next deep dive.